Matrix is proud to be the exclusive sponsor of Shorts with Liz Clark. With over 20 years as a dedicated supporter of the fitness industry, we're thrilled to continue a partnership geared towards success for all those who believe in better.
Well, hello. Thank you all so much for joining me for our next episode of Shorts with Liz. And I am so thrilled today to have three very special guests joining us. We've got Brian Smith from Piper Sandler, Hugh Paisley from RBC Capital Markets, and John Canarick from North Castle Partners. All very familiar with the health and fitness industry, all very knowledgeable on our businesses, and really excited to dig in here on Shorts. So we're just going to go and get started on talking about overall forecasting and the state of private equity lending in 2025. And with their knowledge and their experience, I think this is going to be a really rich and detailed conversation. But without further ado, time is money, and literally time is money to these guys. So I want to get us started. So my first question is going to go to you, Hugh, and that is around public equity markets and how do they influence the overall industry?
Thank you, Liz. So look, I think overall public equity valuations in the, within multi-unit growth, we'll start there, have traded down, since 2021, since the heights of 2021. And that's really kind of a function of where interest rates are and cost of debt and returns on invested capital on multi-unit stories. I think what we've started to see is with equity markets looking forward, particularly in the stories of Lifetime Fitness and Planet Fitness as the two largest publicly traded health and fitness companies, that we've seen the equity market start to look forward. And we've seen a very increasing slope in terms of kind of the stock price performance in those companies. Leonard Green and TPG both did follow-on offerings just recently, both in November and right before the end of the summer in the Lifetime Fitness story. And then Planet, following succession with the leadership team, has traded up quite significantly in recent months. And I think overall that sets a tone that investors like the fitness category. And, as we start to think about what can happen on the private side, is that will start to influence exit valuations as companies think about, what they do when they look to sell themselves, that underwrite, on the private equity side, and John can comment to this, is that the IPO markets become a viable exit strategy.
Excellent. Thank you so much, Hugh. And I think, so you talk about, obviously, Planet Fitness, Lifetime, big monster brands. But there's also a whole other world, right, of the Health and Fitness Association with the thousands of members that we have. And so I think I'd like to turn it over to both John and Brian on specifically a little bit more on medium size and smaller size, is that how can they benefit from larger public companies like yourselves?
I'm happy to start. I mean, I think there's a big difference between small and medium, and obviously there's that definition or what falls into what categories in the eyes of the investor or the beholder, I guess. But look, valuations in the public markets matter a lot. People like to use comparables and sentiment to help sway kind of where they think about things, but nothing matters more in a private equity sale process than the spirit of competition. So if you have a business that a lot of people want to invest in and or acquire, that has a bigger impact on valuation than the trading price of Planet Fitness or Lifetime Fitness. And so it's much more micro in the private equity market than it is big picture, macro. Planet trades at this, Lifetime trades at that, Exponential trades at this, and therefore that's the valuation of your 7-store chain of gyms or your boutique fitness studios or whatever the case may be. It is a lot more related to the individual performances of the business and the scalability of the business, the management team, and a million factors. So while it does matter, because sentiment matters. And so it's great to see things trade up. It makes us feel better about the valuation of the businesses we own or invest in today. But there's a micro story, and I always encourage people not to get too hung up on, well, Lifetime trades at this, and therefore I'm worth the same multiple. Lifetime is a long-standing, large, proven, cash flowing, all sorts of positive things to say about it.
Yeah, I think just to tie those two, points and thoughts together. I mean, I think number one, as Hugh pointed out, there's really a dearth of publicly traded assets in the fitness market, you've got really four. You've got Planet Fitness, Lifetime, Exponential, and then F45 previously, right? And so I think to John's point about competition, unlike a software type business where you have the potential for a VC or to trade from a VC to a private equity firm, a strategic acquirer, or the public markets as viable exit options. Historically, you really haven't had that for privately traded, privately held companies. And so, as John alluded to, the valuations, while sentiment matters, they don't really influence what's taking place in the private markets. What's taking place is really the lack of viable alternatives. And so really it has been just mainly private equity trades from sponsor to sponsor. And we are now starting to see a little bit of consolidation, which we hope obviously will boost up overall valuations, and then seeing what's taking place in the public market also helping with that sentiment and the track record that both Planet is providing on the HVLP side and Lifetime on the full service luxury side. I think all will be very telling and beneficial to SMB businesses as we go forward, along with, as John alluded to, the overall, really positive consumer sentiment I'm sure we'll discuss a little bit later.
Yeah, so I think that you all have just mentioned some really interesting things about, historical background, what that looks like, the bigs versus the smalls. I would love, though, if you can all three maybe look into your magic 8 ball and tell us some of the trends you're seeing right now, because I think our listeners are going to be very interested in that, but that what you expect early in 2025. Yeah. Maybe I'll start with, go ahead, Brian.
Oh, look, I'm happy to kick off. I mean, I personally believe there's no better time to think about investing in this category. I mean, I think if you look at the top of the funnel in terms of demand, coming out of COVID, there's general sense of, wellness matters. Number two, you have things like semaglutide and GLP-1, obviously driving people, and you need to complement that with a fitness offering. You have younger generations spending more and dedicating more time to broader wellness. And that really is the key. I think fitness, and I'll be very curious to hear John's, sentiment on this along with Hugh's, is almost becoming wellness, not fitness. And I think, when you look at the big box offerings, the ability to now offer not only just fitness and isolation, but more recovery type services, massage beds, infrared soda, cold plunge, it just enhances the overall value proposition to that member and increases the frequency by which they should be coming into those four walls. And so from that standpoint, I think that is going to be the continued theme here is, more demand, that 20% moving up to 30% over the next 10 to 15 plus years from a population penetration standpoint, and the move from not just being exclusively fitness for broader wellness.
Yeah, I agree with the overall sentiment. Trends are really good. Attendance, membership joins across the different businesses that I'm directly involved with are really strong. And I don't see major risk to that on the horizon. I mean, you have the general risk of economic concerns that have been looming for years now, really, right? Since COVID, and some discretionary spend, concerns in the broader economy. But I think, as Brian said, like most people don't view this as discretionary, right? Most people view fitness as core to their life, and more and more complemented by the wellness and recovery services that Brian just talked about. Look, there are players that are well positioned to do everything that was alluded to there, like Lifetime, like Equinox, and there are other companies that are not well positioned to do everything and should be really good at providing a solid value for what they're really good at. Right. So boutique fitness studios are not going to all of a sudden have cold plunges in their four walls, and neither is Planet or Crunch, or at least I don't foresee that happening. I guess anything's possible, but the backspend to create a cold plunge environment is not so simple to accomplish. Now, there might be some really interesting innovation that comes out that provides a similar recovery experience that doesn't involve 39-degree water for the lower price end of the market. But overall, Liz, like I do think the consumer is really strong for these various services, from the high end to the low end of the price point spectrum, to the specialists, to the broad-based providers.
I guess just adding on, I mean, zooming out, I agree with both Brian and John that it's health, wellness, active lifestyle. We're seeing a convergence across many different areas along the continuum, whether it's physical, more experiential offerings that we'd classify kind of your traditional gyms or boutique studios or some of the relax and recovery studios, to products that are being sold to those consumers and how they reach those end consumers. Lifetime highlighted how they're expanding their app to become much more of a marketplace to their consumers. We've seen a lot within the pro shops, boutique studios on the higher end, and we see more interest from that. And then we also see a lot happening on the digital side, and gamifying some of these experiences and what you can do at home and what you can take with you to the gym, in terms of kind of direction. And that's creating a lot more social influencers that's continuing to reinforce growth and demand.
Brilliant. Well, I think you all just said, so the notes I'm taking are really deep here. And what I want to say is there's a couple things, is that Brian, you said something about more demand and 30%. And one of the things we're working on as the organization is to have our country by 2030, 30% of people being active and healthy. And so it lines right up with what we're working on as the association. And then John, what you said about maybe we'll see some innovations. I'll make a quick plug here that hopefully we'll see a lot of those innovations at our trade show in Las Vegas, March 12 to 14. So plan on joining us there if you're not already. So thank you. I know you can't speak totally about all the deals that are going on in our universe here, but I was wondering if you might comment on the likelihood of some private equity backed deals in 2024 and what that could mean for the overall industry. I think we just saw a major one. I'd be curious to get your sense of what you're feeling and what you think that looks like now.
Look, I do think 25 we'll see an uptick. COVID took a lot of dollars out of this category, or it shifted it, I should say, right? A lot of dollars went into home fitness for, a couple of years before, and that then became a really big struggle, from an investment, standpoint. That growth was incredibly difficult to manage, and then the air fell out of, that balloon, and the consumer shifted back to in-person fitness. And I think there's been a couple of years of a lot of wait and see, and how's the recovery looking, and how's this looking, and some Planet Fitnesses traded at very high prices before COVID, and then I think had some more depressed prices a little bit after COVID. I think it's all stable and all on the up and up from the best I can tell, and private equity loves stable cash flowing businesses. And so I think the further we get away from COVID, the closer we get to pre-COVID levels of results, or way beyond that for some brands, the more likely it is that private equity will kind of enthusiastically come back into the category. I think the only holdup is what Brian mentioned before, is that most of the trades, once it's private equity invested in or owned, minority or majority, is to another private equity firm. That is where most of the trades happen, and that is the one hang up. And it would be great if we saw some strategic capital coming into the category. Hugh and Brian have probably a lot better sense for whether that's going to happen or likely to happen than I do.
Yeah. Listen, I think John touched on a good segue, which I think we saw a lot of activity in 2024, and again, especially coming out of COVID, where you start to have a couple of 24 months behind you in terms of great trends, great attendance, great usage, and people's war chests coming back, and people wanting to dip their toe back into the fitness category, mainly from the private equity side. I think we'll see the same in 2025. I think we will see some consolidation, which may open up some additional exit opportunities, as we touched on, being very, very important. You saw the merger of AFI and self-esteem brands and Orange Theory. Could you see some consolidation in the big box arena potentially? We see further consolidation, some of the franchise systems in Planet and Crunch, potentially Club Pilates, et cetera. I think, but taking a step back, I think the biggest challenge with investment from private equity, I think, into our category is the returns on capital and the time it takes to see those returns. This is not like food businesses where you open up 10,000 new doors and overnight you're able to grow revenue by 50 or 60%. It takes time to identify a site, build a site. And when you have a private equity firm that's typically holding between 3 and 5 years, and you're not seeing those returns for 5 years, typically in our industry, it's more of a challenge. I think you're starting to see more of the secular tailwinds offset that. And my sincere hope, and I'm sure Hugh is in the same boat I am, working on the sell side, is that the appetite and the audience for buyers will expand, both from a private equity standpoint and from strategic, just based on what we're seeing on the secular side, which is there is no other consumer category that has the tailwinds behind the category that we do. As John alluded to, this is not discretionary. These are routine usage, the last things that people will forego, and especially as we get those younger generations coming in. So again, I think setting up for the next 10 plus years, there should be a lot of enthusiasm from the investing community, which I think is a great backdrop for 2025 and beyond.
Yeah, just to add on to what John and Brian said, is I think overall deal activity, I mean, you think about it in terms of red and blue states, and a lot of the concentration of a lot of the activity that has transpired post-COVID has been, in southern states where they had a longer trajectory of being able to open new units, and growth was a core part of this industry. And as you look out, it will continue to be, particularly with all the mega trends that we've talked about. And I think that now that there's a much broader recovery, and post-COVID normalization, you have several years of seeing those membership trends come back. We saw a lot come back in California, and in Canada more recently. But then I think part of the lag here, as Brian alluded to, is it just takes time to now start opening boxes and being able to show that the new unit economics can still generate the same as pre-COVID.
So Hugh, this was the perfect entree into our next question, because you just said something that's really near and dear to my day-to-day life, and that's red and blue states. And what does that look like from a policy perspective, and how do we make sure that everybody is open and thriving? And so I would love to get your all's reaction on, now that we are on the heels of an election, your thoughts on predictions of maybe what the cost of capital could mean, what inflation could look like, and any other sort of major economic trends that now that we're again on the other side of the election, what that might mean for us. So this is a question for everybody.
I'm happy to start. Look, the question's obviously best for global economists and not for the three of us. But we all have our perspectives and opinions, some of which we're willing to say out loud, and some of which we keep tightly shut inside from public podcasts. But look, I think the Fed has indicated or signaled that rate cuts are likely to be slower than they might have been because of potential inflationary policies. Those inflationary policies might be great for the economy. We'll see. Time will tell. But I think, at least as far as how I'm forecasting interest rates for the companies we currently own and or invest in, or companies that we are considering investing in, I am not counting on another 150 basis points worth of decreases over the next 4 to 6 quarters. That's just not what I'm reading in the popular press, and that's kind of my best source. I'm not a global economist and don't have one employed by our firm. That does have implications for the cost to build and the cost to borrow. Whether we see a return of actual inflation for commodities, I'm hopeful that won't indeed happen. But obviously, if we start tariffing steel from Canada, it's going to be more expensive to build new stores, and it's going to be expensive for the equipment companies to build new treadmills, and or we import a lot of treadmills from China, right? If those start getting smacked with 25-50% tariffs, like, that inflation is going to slow down store growth and meaningful capital project renovations. Really hard to say, Liz, what's going to happen. My opinion on all of this stuff is no more interesting than all of the other things we read and hear. But I guess where I could give a perspective is, if the cost to acquire materials goes up a lot, it will slow down capital investment. It has to.
Yeah, I think, listen, I think the last 2 years we've been living through, a hyperinflationary period. Cost of build skyrocketed. I mean, this resulted and caused major shifts in our industry. I mean, Planet Fitness obviously being center stage with its $10 a month pricing moving to 15. That was a direct result of the inflationary pressures they were seeing in terms of unit level economics and being impacted. That obviously is a major benefit, I think, to the rest of the industry because of the marketing fund that Planet Fitness has to educate the market on pricing, which I think allows all parties to really benefit and kind of moving price up to recapture some of those losses that have been driven by what we've seen in rising prices. I mean, we were the last industry really to raise price versus every other industry that took the opportunity to bump up 20, 30, 40% to kind of pass that through the consumer. And I think, again, and John can speak to this with assets like Barry's, where you see great resiliency in that consumer, not in expanding. And so, again, it shows that the share of wallet, the dedication, the focus, the commitment to these types of services and products is there from the consumer, and they're willing to absorb that to, again, experience a great, offering such as, Barry's or any other of the many fitness, brands out there.
And I guess just to add on, I mean, I think the good news is that while there may continue to be inflationary prices on the on the building costs, is that we have entered a period where we went from easy money to high inflation and a rate tightening cycle. That at least now we're at a point where there's stabilization and assets can be priced and everybody can model them, and that's going to be helpful in terms of kind of overall deal activity. The second thing that we've seen is kind of a broadening of lending sources that are out there. You have direct lenders, which were largely very, very active over the last 18, 24, 36 months. We've now seen syndicated markets open up, to the sector once again. We talked about public valuations being up. That certainly helps support that. We have seen, post-COVID kind of normalization in terms of the financials, which is going to help kind of the credit side of the business. And then we continue to see disruption more broadly across bricks and mortar away from the fitness sector, which is opening up new locations and really kind of creating some pressure on landlords to figure out a solution to build out new sites. And so we're seeing a lot more activity around and creativity around the structuring of those deals.
That's a tremendous point that you just made too. I mean, again, if you think about the real estate landscape and where it was 10 to 15 years ago, where fitness centers were looked at as impediments or took up too much parking, a real challenge to the overall center. That has fundamentally shifted. Where now we drive foot traffic, we drive rents for other tenants at those facilities. And again, as Hugh alluded to, it has opened up a new category of funding for a lot of these big box operators, where people are willing to do the build outs, build a suit for operators that kind of allow them to push those costs into the rent structure and offset the heavy capital need, which again can help small and medium-sized businesses as well as the larger publicly traded companies. But I think that's a tremendous point that Hugh made, which is just that opening up of that real estate side in terms of really being an anchor tenant and what that does from a funding standpoint.
Yeah. So, I mean, that was actually one of my final questions, which you've just answered, Brian. And but I mean, there might be more to add, but it's really what are some of the differences that you all are seeing from the perceptions of our industries and our businesses versus maybe some other consumer related industries, and maybe expand upon that a little bit more. I'd love all of your thoughts on that.
The demand for fitness is really good. I mean, it's really, really strong. The consumer prioritizes their fitness lifestyle, I think, far more than they do, another meal out, or some physical good. So, when I look at our data, there was a massive swing underway before COVID on consumers spending more money on services than products. Younger consumers in particular. Obviously, COVID turned that on its head, and we were home and buying, all sorts of, stuff. And we overloaded our pantries, and so services come back hard. That includes, taking a trip to Europe or something like that, right? So experiences, services. I think the trend has sort of emerged, right? That was there before COVID. And so I tend to think that's uh, a more stable, preferred category for consumers. And then within service, fitness is top, right? People want to go to the gym, they want to work out, they want to get their classes, they want to get their personal training. It's they want to get their recovery services. It's all really is quite a healthy, positive thing. Whereas in other categories, I do think we are seeing some more discretionary decision making because inflation did hurt people. It's not totally in the rearview mirror, even though that inflation we're seeing today is low. Prices are still elevated to what they were a couple of years ago, and that's not going to change. There's still some amount of uncertainty out there for a lot of Americans. So if we're comparing, I think this is a really healthy place to be. For all the reasons I think that both Brian and you and I earlier touched on.
I mean, just to add to that is the insulation from online and what e-commerce might have versus other areas of bricks and mortar retail. Just layering that on, and then the unit economics themselves and subscription like revenue, negative working capital benefits. I mean, that all kind of speaks to the fundamental thesis and why we see a lot more interest. I do think that the umbrella under which health and fitness, active lifestyle is expanding. And that's going to create new green shoots for different companies to grow and leverage the membership base and influence the consumer purchasing decision. And that'll be an important driver as well. And so the company will, the sector will still continue to evolve. And so, fundamentally, you start with growth, and then you say, okay, it's got plan A is just continue to open up new units, which is working. But then two is that we're also seeing that broadening of tentacles and reach.
Yeah. Yeah, I would say, listen, there was a high-flying CEO that said gyms are going to go the way of Blockbuster back during COVID, and I just think that is just inaccurate. Given we are social beings, we want community, we want to be around others. It's really hard to replicate all the offerings within the four walls of a gym at your home. You can do it with certain modalities, but you can't get that full experience. And most importantly, we are social beings, and so. I do think, again, the best days are ahead of us. This is not discretionary. And again, that younger consumer that's continuing to now be that next wave coming in and everything behind it. So we're curious population. I mean, you see, the consumers 18 to 35 taking better control of their lives and making that wellness a priority. And I don't think that's going to change. I think that's a tidal wave that's coming and only will, again, help you get to that 30% penetration you're looking for. And let's hope it gets to 40 or 50%.
Can I just add one thing? I think that Brian touched on it earlier. There's this massive thing happening called GLP-1s, right? Everyone is aware of it. There's a great article in the New York Times about the massive impact it's already having on the food industry, the junk food industry, and all of the work they're doing as an industry, right, to try to protect. And so I think it's incumbent upon this industry, and Liz, obviously you're best positioned to lead this effort to make sure the GLP-1 consumer knows how important the fitness is as part of that long-term healthy lifestyle decision. And we all know the muscle loss, and the studies are very clear, right, as to the positives and also the risks or negatives. And I think the fitness industry is in an incredibly well-positioned place as to, how do you get to 30 in 2030? That's how you get there, right? It's the consumer who had given up on that part of their life, was not interested in fitness, but has made that investment in changing their bodies, changing their lives through GLP-1s, that needs to find the gym. And I think we're starting to see that. I think a lot of companies are advertising specific programs that are, used in concert with GLP-1s. But there's just an overall message, right? Which is you need to lift weights. Like, period, full stop. You need to lift weights. Like, go to the gym, get a trainer if you don't know how to do that. Download a program if you can't afford a trainer. Go to Planet Fitness, go to Crunch Fitness, go to Equinox, go to wherever. Go to the gym. And so I hope the Health and Fitness Association is going to lead a sort of broader national campaign to drive that consumer in.
Yeah, I'll just speak to that, John. It was something that I've been obviously asked about very early on when the GLPs really were hitting the scene. And they said, what's our position? Are we going to fight Big Pharma? I said, no, we're going to embrace it. And we're going to say, if this is what it takes to start to get you healthy, okay, well, we're going to get you across the finish line on it. So I do think that there's a world for all of us, an important message for us to be embracing on that. So I'm happy to hear that you share my opinion
Yeah.
with that.
There's no
So
fighting it.
good. Well, yeah, I mean, so listen and close. And then also to your point, Brian, I saw a report a couple of weeks ago about specifically the younger generation that are leaning into their health, and that more people now are going to the gym of that generation than they are going to bars.
Yep.
So I think we're really going to see a tremendous shift, in coming years here with upcoming healthier generations that maybe has not been the case in the past. So I just want to end with, because I asked a question a little bit earlier about it, specifically, again, looking at the universe of all of our thousands of members and the small and mediums particular. Let me just ask you all, how do they get your attention? I think that we know, that there's so many innovative approaches and people are running tremendous businesses out there with all kinds of different modalities and all kinds of different offerings. And you are literally like the pot of gold, I think, for so many folks. And I would just love to know, what is it that interests you? What is it that you look at? And what should some of our listeners be thinking of with that kind of lens to get your attention?
The advice I give to people who have smaller businesses that strive to have bigger businesses and want to attract growth capital as opposed to liquidity capital, right? There's two very different types of transactions. I mean, there's more than that, but broadly speaking, is the first thing I say is like, build the business as if you're going to own it forever. It's got to be a great business where you truly, if you had the capital, you would put it to work. You would put more money in the ground to open your third, fourth, fifth, seventh store. And you're not just doing it to get to a number size that attracts the private market capital into your business. It has to make sense. Understand why you want to attract private equity capital. Because I don't think that everybody needs to attract it. I think there's such a thing as starting a small business and doing amazingly well, owning 100% of a small business and growing it over time and slowly, and having a great cash flow company that you own. And so it's got to be the right reasons. It's got to be the right business model. But Liz, there's just some basic things when it comes to four-wall, and we could talk about equipment. We could talk about, there's obviously all sorts of parts of this business. When it comes to four-wall, like the unit economic model has to be believably scalable. It's I don't hate to say it's that simple because it's like, what does that mean? But it has to be provably scalable, meaning, you're doing it successfully in multiple locations that are not all exactly alike. You are beginning to think about the talent that you need to scale it, the infrastructure that you need to scale it, and that you truly want an investment partner to help take it up in size from there, both in capital and expertise. That's how you get my attention personally, is like, hey, I got 4 of these things. Here's the numbers. Like, they're really compelling. How do I get 4 more? Like, that's the fastest way to get a conversation started, I guess.
Yeah, listen, I would just add on to what John said. It all comes down to the unit level economics and the benchmarking at some point to attract the capital, because it has to be self-sustained and ability to reinvest and grow. But I do believe, fundamentally that, this is a category where there are very low barriers to entry, right? And so the idea of having that secret sauce, that special culture, the team you've built around you, the customer evangelists that you have, the social media and the reviews you're seeing, like, those are the things I think are additive around the edges to those underlying unit level economics. And then the ability to demonstrate ownership of a certain market, a certain modality. Those are all things that I think get myself, and I'll let Hugh speak for himself, very excited about speaking the gospel and that message to the broader market, like John, to get you funding to continue to grow your business. But it all starts with unit level economics and how do you compare relative to your peers. But then, secondly, are you building something that can sustain? That really is that culture and the customer review, the retention of that membership, and the overall value proposition that is outside the numbers that comes through that word of mouth, that badge of honor that your customers are wearing to promote your brand, the word of mouth, like all those things are what I think really help differentiate in an industry that does not really have, IP or moat around it. That score.
Yeah, I agree with all the points that were raised by John and Brian. I think that there's two pieces. I mean, one, it's kind of focused on, are you cash flow yield story or growth? Are you looking for debt or are you looking for equity? In terms of kind of how you finance your overall business. In addition to the comments around scalability, replicability, the culture, defensibility. Is really don't underestimate bookkeeping as being able to kind of really track and measure those. Is that it kind of all starts as you start to look for institutional capital in whatever form. Having the processes and systems in place to do that effectively. Will carry through one. It helps beyond just the initial introduction, but then it also speeds things along in the back end as well.
Fantastic. Well, thank you. Listen, gentlemen, the name of the show is Shorts. We could be here all day, but I am going to try to promise and keep it short and just say thank you all so much for everything you're doing. Thank you for sharing this wisdom with us today. And I'll just tell you some really exciting takeaways, that I've heard today, that the demand for fitness is strong. We are a healthy place to be, and there is no better time to invest in this category. So thank you so much for all of that. And I look forward to continuing this conversation in the future, but thank you for being here today.